Welcome to the Deep Dive. Today we're plunging into the dynamic world of Australian property. Specifically, we're looking at the key movements and trends from May 2025. We've pored over this really extensive month-in-review report. It's packed with insights from experts across commercial, residential, and even rural property all over the country. So our mission for you today is basically to cut through all the noise, pull out the most important nuggets of knowledge, and help you understand the forces shaping the market right now and, what your money truly buys. Okay, let's unpack this. We've got a fantastic deep dive for you today into the very latest in Aussie property. We'll start with some big national headlines. These really set the stage for everything else. The report highlights two significant events this past month. First, a surprisingly decisive federal election. And second, a key move by the Reserve Bank of Australia, the RBA. So the election first. The sitting government secured 94 seats. That's the most in its history. And there's speculation, the report notes, that this reflects the electorate wanting continuity during what's been a pretty tumultuous time.
Right. Stability seems to be the key word there.
Exactly.
Yeah.
And crucially, the RBA cut the cash rate. 25 basis points this month, that's 0.25%. Reducing it down to 3.85%.
And that's prompted a lot of lenders to move, hasn't it?
Oh, absolutely. Over 80 lenders, including the big banks, have announced cuts to their variable rate home loans. And these rate cuts, they directly translate into, the report says, increased borrowing power for new buyers.
Which is key.
And cash flow relief for households with existing mortgages.
Also key.
Both of which, as the report puts it, play to the property market's advantage.
And the banks are even forecasting more cuts, right?
They are. Major banks predicting the cash rate could fall further, maybe to 3.35% by the end of the year.
What's fascinating here is how this combination, the political continuity plus the easing monetary conditions, the report explicitly describes it as creating a particularly favorable environment for property investment. And it contrasts that with previous election cycles where uncertainty usually, dampened activity.
Yeah, that predictability seems valuable right now.
It really does. Makes you wonder if that's the new premium.
That's a crucial distinction. These big economic and political shifts are so critical because they directly influence interest rates, lending confidence, the whole market trajectory, really. Ultimately, it impacts your buying power and what you're paying on your mortgage, if you have one. Okay, our deep dive next takes us into the commercial retail sector.
This is a fascinating area, kind of finding its balance after, years of big shifts towards online shopping. Nationally, looking at consumer sentiment, it's still on shaky ground. The Westpac Melbourne Institute Consumer Sentiment Index actually fell 6%, hit a 6-month low in April.
Right, and that's linked to external things, like U.S. tariffs.
Exactly. U.S. tariffs on Aussie goods, impacts on share markets. The report mentions those. It seems many consumers are still worried about the economy and, their personal finances.
Understandable. And retail turnover reflects that. It's remained, quote, relatively flat over the past couple of years. Not surprising, really, with cost of living pressures and those higher interest rates we've been dealing with.
But there are some glimmers of hope in leasing.
Yeah, the report points to some positive signs there. While there's still downward pressure on rents in many areas, landlords and tenants seem more willing to negotiate, and that's leading to more leasing activity, which is good.
So deals are getting done.
Seems like it. And what's particularly interesting is this retail rebound they're seeing in the major CBDs. Melbourne, Sydney, Brisbane. Foot traffic is increasing. You've got more workers back in offices, students on campus, more visitors for events, hospitality.
So people are coming back into the cities.
Exactly. And retail vacancy levels are actually reducing. Hospitality, food and beverage, entertainment, they're the ones taking up most of the new space.
Makes sense. People want experiences.
And there's also more construction and redevelopment happening, especially in those growing outer suburban areas. Two key trends really stand out for retail in the report. First, consumers are all about convenience and ease of access.
Right.
So you see things like click and collect drive-thrus, direct-to-boot facilities.
Making it seamless.
Yeah. And second, this ongoing trend of increasing mixed-use development.
The blending of spaces.
That's it. Retail properties expanding to include medical centers, childcare, offices, even residential apartments, especially near transport hubs. Think of places like Chadstone's Market Pavilion or the Chatswood Chase redevelopment.
This raises an important question, though, about how landlords are adapting their core business models. It's not just bouncing back, is it? The report clearly highlights this pivot to mixed-use and experiential retail as, well, a strategic long-term response. It's about fundamentally evolving consumer needs.
Yeah, how we actually use physical spaces now.
Exactly. It suggests a complete reimagining of the whole shopping experience, really.
That's a crucial insight. Now, let's get into the regional commercial insights, because it really is a mixed bag across the country. You see this clear division, some areas facing real headwinds, others seeing pretty robust growth.
So definitely not a one-size-fits-all picture.
Not at all. On one hand, you've got places like Sydney's inner-city commercial market, still subdued, struggling with higher vacancy rates, challenges with parking, foot traffic.
And limited new supply there too, right?
Yeah, mostly just ground floor spots in residential developments. Then you look at Darwin. The retail sector there faces a, quote, difficult journey. Vacancy rates are stubbornly high, and there's this pervasive issue of petty crime, sometimes escalating. That's making it incredibly tough for businesses. Security costs are apparently sky high compared to similar centers down south.
Oh, that's a significant challenge beyond just economics.
It really is. And Karen's inner-city retail, heavily reliant on international tourists, is still struggling post-pandemic. Rents are down.
So some deep-seated issues in those areas.
Definitely. But then, on the other hand, you see strong activity elsewhere. Newcastle's large-format retail space is thriving. Click and collect is working well there.
Good to hear.
And Queensland's major cities are, well, buzzing. Brisbane's sector is described as active, lots of new development, refurbishment.
Driven by population growth and infrastructure.
Yep. Population growth, huge projects like the Brisbane Metro, Cross River Rail, thinking ahead to the 2032 Olympics, plus changing consumer expectations for experiences and just retailer demand.
And the Gold Coast, too.
The Gold Coast is undergoing a significant evolution, a wave of innovative new developments. And that mixed-use trend is really defining things there, integrating residential, commercial, retail seamlessly, projects like The Lanes, Marina Mirage.
So a very different story down there.
Completely. Even regional hubs like Townsville are seeing significant expansions and refurbishments in their master plan communities, though the CBD there faces challenges from urban sprawl. So what does this all mean for commercial retail? It's a highly localized story. Some areas thriving, others facing serious headwinds. The report really hammers home that national trends often mask these very different realities on the ground. Shows you how localized property markets truly can be. Right, let's turn our attention now to residential property. This is where we hear that term median price constantly in the news everywhere. But what does that number actually mean for you on the ground? And here's where it gets really interesting. And frankly, maybe a bit of an aha moment for a lot of us.
Yeah, that median price can be tricky.
It really can. The report highlights that while median house prices are a key indicator, that single measure doesn't always reflect the price movement of individual homes.
So the median going up doesn't automatically mean your house value went up.
Exactly. It might just mean there was a shift in the types of property sold. Maybe more high-end homes sold that month, pulling the average up. And get this. There could be a 10 to 15% difference in median house price movements between renovated or newly constructed homes and those needing work or development.
Wow, that's a big gap. That definitely skews the overall number.
Hugely.
And if we connect this to the bigger picture, the report strongly advises against relying just on that median price in isolation. It says it's crucial to look at various indicators, specific property attributes, and consideration of regional differences to get a truly accurate picture.
Right. That national median can mask regional disparities. Sydney's median is obviously way higher than Adelaide's or Darwin's.
And even within one suburb, right? A house with views versus one on a busy road affects the median differently.
Totally. It challenges us to think more critically than just reacting to that one number we hear. And crucially, that median house price does not directly reflect affordability. The example given is Brisbane, median house price up 96% over the past decade. That's potentially way ahead of wage growth.
Yeah, affordability is a whole other layer.
So that single number, it can be quite misleading.
Yeah.
This deep dive hopefully gives us the tools to look beyond it. So let's dig into what the median price actually buys across Australia and maybe some strategies people are using. We'll start with New South Wales. Okay, Sydney first. Median prices have started to recover a bit thanks to those RBA rate cuts we mentioned. The house median is sitting around $1.47 million. Units are lagging a bit, down slightly, around $851K.
But that's just the overall Sydney picture, right? The report breaks it down further.
It does, and that's where the nuance comes in. Across Western Sydney, for instance, you see different patterns. Established areas like Glenhaven, median's $2.69 million. That gets you a renovated large home, premium prices. But if you want something more accessible, maybe a modern 5-bed, 3-bath duplex,
Yeah.
you look at South Wentworthville, median there is around $1.295 million.
And the report mentioned a strategy for buyers there.
Yeah, a savvy buying tip, apparently. Consider a 3-bedroom place and renovate or extend to create a 4th bedroom. They show in Northmead, a 3-bed is $1.4 million, but a 4-bed jumps to $1.7 million. So potential value add there.
Interesting. Build equity through renovation.
Seems to be the idea. Then in the Southwest, suburbs like Airds offer opportunity for first home buyers and investors. Median around $809K for a basic 3-bed home. Good potential for medium to long-term growth. But then you have new developing estates, like Austral, modern homes around $991K, but suffering from, quote, a well-publicized lack of infrastructure and services.
Ah, the trade-offs.
Yeah, and constant supply of competing rental stock.
Yeah.
So affordability in new areas can come with those kinds of challenges.
Yeah.
Moving over to the North Shore, huge variation there. Lane Cove median, $3.45 million. But nearby Lane Cove North is $2.65 million, seen as an attractive option, being close to the CBD,
Yeah.
slightly better affordability.
And prestige areas.
Lake Mosman, $6 million median, called a barometer of performance for that high-end sector. But the report keeps coming back to this point. Just because a property sits at the median price doesn't mean it's a quality asset.
Right. Focus on the fundamentals, location, land, orientation.
Exactly. Future buyer demand. Looking at regional NSW quickly, places like Coffs Harbour are seeing a slight resurgence. House median $797.05K, units $570K. Interestingly, both offer similar gross rental yields, around 4.45%. So units are a more accessible entry point for first home buyers there.
Makes sense. Lower purchase price, similar return percentage.
Shoalhaven shows renewed confidence, markets stabilizing. But then the report highlights how specific factors can skew medians. In Lismore North and South, the sales data is impacted by the flood buyback scheme, which used pre-flood values.
Ah, so the reported median doesn't reflect current market conditions necessarily.
Precisely. The report warns, without a carefully framed context, a lot of this truth can be misconstrued. A real warning about understanding the why behind the numbers. Okay, let's head south to Victoria. Again, the report emphasizes quality over just price. The true measure of a property isn't just its price, but the quality it delivers. In Melbourne, CBD units median $600, $610K. They offer higher rents compared to the metro average.
But not necessarily the best for capital growth.
Exactly. The report warns investing in CBD apartments is not an optimal strategy for significant capital appreciation. It says properties with a land component exhibit stronger price growth.
Land value is key again.
Seems to be a recurring theme. Looking at Melbourne's northern suburbs, Fitzroy North houses around $1.4 million, units $605K. It's well established and tightly held.
Meaning limited supply drives competition.
Yep, which is good for longer-term capital appreciation. Compare that to Donnybrook. Median house, $657K. It's an emerging and developing suburb, popular for affordability.
Not the downside.
A large abundance of stock and a slightly higher vacancy rate. So it's that trade-off again, established scarcity versus emerging supply. All right, shifting up to Queensland. Brisbane. Median house is roughly $1 million, units $650K. Now, the report gives a pretty candid view of what $1 million buys you for a house in inner-city Brisbane.
Let me guess. Not a palace.
Oh, no. Likely small, requiring serious repair on a tiny allotment or in a secondary position like on a main road.
Okay, managing expectations there.
Definitely. For units, $650K gets you maybe a good quality 1-bedroom unit in inner areas like Newstead or an entry-level investment-grade 2-bedroom unit a bit further out. And a warning. New properties are costing a pretty penny in the current climate of high construction costs, and it may take some time to recoup any premium paid.
Good point about paying a premium for new builds right now.
On the Gold Coast, median prices cover a diverse spectrum. And that defining trend, again, is the rise of mixed-use developments in new construction. The advice for buyers there: exercise caution and conduct thorough due diligence.
Don't just chase the median.
Exactly. Prioritize evaluating the property's specific characteristics, potential future value, over just its alignment with the median. Crucial advice, especially in fast-growing areas. Beyond the capitals in Queensland, regional markets like Rockhampton and Gladstone are showing really impressive growth, double-digit growth. Rocky's median house price is $507.07, up from about $370K a year ago. Gladstone's is 550 gators, up around 30% in 12 months.
Wow, driven by infrastructure and affordability.
Yeah. The report cites major infrastructure projects, a diverse local economy, and relative affordability as drivers, calls them good buying opportunities. Meanwhile, somewhere like Hervey Bay, median house price hit $737.05. That's up 71% in just 4 years.
71%.
Incredible. But it's led to declining sales volume because stock is low and demand is high, making it really tough for first homeowners to get in. Briefly touching on South Australia, Adelaide's overall dwelling median is $827.06, up a significant 11% in the last 12 months.
Still climbing strongly then.
Yeah, the report noted prices have climbed drastically in recent years, and it's increasingly difficult to predict if or when this may happen, meaning when it might stagnate. Okay, over to the West. Western Australia, Perth's median house price, roughly $750, up a staggering 22% in 2024 alone.
22%? What's driving that?
Report says significant migration fueling demand and rental prices on the rise.
Yeah.
Inner ring suburbs like Perth itself, $1.25 a house, and Subiaco, 2.2-meter house, command those high prices. But regional WA is also showing strong growth. Port Hedland, median house $790K, but check this, renting for $1,400 a week.
$1,400 a week, that's huge yield. Mining related.
Driven by robust mining and investor demand, yeah. And Geraldton, particularly the suburb Rangeway, saw a 47.5% year-on-year increase. Median, they're only $295K though.
So big percentage jump off a lower base.
Exactly. The overall WA market is described as showing resilience and adaptability. Darwin, Northern Territory, still Australia's most affordable capital city. Median house, $604K, units, $367K.
And that affordability is attracting investors.
Yep. Interstate investors acquiring affordable properties, often with tenants already in place, getting yields of 6% or higher. The report says quality real estate is attainable around that $600K mark, especially northern and inner suburbs with decent block sizes. Turnkey properties, updated kitchens and bathrooms are preferred due to high construction costs up there. And finally, Canberra, ACT, house median 962Ks, unit 587Ks, townhouses around 720Ks. Slight decline from 2024. What does 962K get you for a house? In the inner ring, probably an older, smaller cottage in need of renovation, but offers long-term capital growth potential.
Location, location, location.
Pretty much. Middle ring, bigger family homes on larger blocks. Outer ring, new 4-bedders on smaller lots. For units, inner ring means newer 1 or 2-bedders, but the warning is about high-body corporate fees.
Ah, yes. Those can really eat into returns. Can be 15, 20 grand a year sometimes.
Easily in some complexes, and lower growth potential if oversupply hits. The core message, again, echoes across all states. Just because you're buying at the medium doesn't mean you're buying smart.
Focus on land content, build quality, location fundamentals. It keeps coming back to that.
Okay, for our final deep dive today, we're shifting gears quite a bit. We're looking at a surprising but crucial part of the Australian property market. Rural land developed for cotton production.
Right, not something people immediately think of as property market.
Exactly. But the report makes it clear. Water has become a key component of value within these irrigated cropping assets. And sometimes, it says, water can attract demand far higher than the land itself.
Wow. Water rights is the prime asset.
Yeah. And this is driving farmers to explore new geographic regions like the Queensland Gulf and the Ord River irrigation area up in WA. Commodity-wise, the global price of cotton has seen, quote, moderate softening over the last couple of years. It's around $600 a bale currently. But growers apparently now consider this the new 500, referencing the old minimum worthwhile price. Why? Because production costs have increased so much.
So the break-even point has shifted upwards?
Seems so. Seasonal conditions have been mixed, impacting yields and quality. But the Bureau of Meteorology is forecasting warmer than average days in the eastern states ahead. Looking at regional activity. Southern New South Wales, the market for irrigated cropping was relatively quiet recently. Good quality holdings are generally remain tightly held because returns have been good.
Makes sense. Why sell if it's performing well?
Right. But there was a significant sale in the Commons aggregation, sold for $88 million. That was for 2,800 hectares, including significant water entitlements. The analysis suggests that reflects about $12,000 per hectare just for the developed irrigation component.
Gives you a benchmark for that irrigated land value.
Now, up in the McIntyre Valley and Darling Downs area, land value growth has stabilized a bit, but the water markets have seen an extremely high level of positive growth. recently.
Water again. What's driving that specifically?
It's primarily been driven by the Commonwealth government's decision to actively acquire water entitlements.
Ah, government buybacks,
Yeah.
creating scarcity.
Exactly. Increased scarcity of water, leading to high level of competition from buyers
Yeah.
when water entitlements do come up for sale. Fascinating dynamic, how government policy directly shapes that market.
This really raises an important question, doesn't it, about the long-term sustainability and, well, the strategic importance of water rights in any agricultural investment. It's clearly not just about the land anymore, is it?
Doesn't seem like it.
We're seeing how government policy, environmental factors, climate, how they can profoundly reshape these market dynamics. Water is becoming this incredibly valuable commodity in its own right.
Yeah, you wonder how that plays out in future land valuations long term.
Indeed. The Australian cotton market is, a fascinating example. Fundamental supply constraints like water, coupled with those external influences like government policy, creating really compelling and complex investment dynamics. It's a good reminder that every corner of the property market, even the ones we don't often talk about, has its own unique set of drivers. So we've covered a lot of ground today. We've navigated the peaks and valleys of Australia's property market, from those big macroeconomic shifts and the localized transformations in commercial retail, to really digging into the true meaning behind median residential prices in, potentially your neighborhood, and even touching on the unique investment dynamics of the cotton industry and water rights. Hopefully you've gained some valuable insights into this incredibly dynamic world of Australian property. Whether you're thinking about buying for the first time, or you're an experienced investor, or maybe just someone who likes to stay well informed, understanding these underlying currents is really key to making sense of it all.
Yeah, this deep dive really underscores that point, doesn't it? In an environment with so much change, so much complex data flying around, the true value lies not just in knowing the numbers, but really understanding the stories, the local factors, the why behind those numbers. So maybe something to think about. What stands out to you about how these varied market conditions we've discussed might shape your next big decision? Or even just how you observe what's happening around you day to day, something to mull over until our next deep dive.